Hey everyone, Netflix reported its quarterly earnings results after the markets closed today, and the results sent the stock price down 5% in after market hours trading. Now, I'm going to review those results. I've highlighted the big items, the key things that surpassed during Netflix's latest quarter. I'm also going to update my buy recommendation for Netflix stock. Remember, coming into the year, I had Netflix rated as one of my top 25 stocks to buy in 2024, and I had it staying there even before these earnings results were released. So coming into these earnings results, Netflix was on my list still. So you're going to want to tune in to see if I'm keeping it there, if I'm bringing it back down, or if I'm changing the recommendation in any way in this video, which I will share with you. So let's jump right into it. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so right off the bat, Netflix, the summary starts off excellently, saying that compared to the first quarter of 2023, revenue was up 15%, operating income was up 54%, and operating margin rose by 7 percentage points to 28%. And for the rest of 2024, Netflix expects the good times to continue, forecasting 14% revenue growth at the midpoint, raising the 2024 operating margin forecast to 25%, all of which is excellent. Furthermore, one of its newer initiatives, which was starting an ad-supported service, previously it was without ads, now it's having an ad-supported service, not only ads, but a combination of a membership fee plus ads to make the price more approachable for some members who may not want to pay the full price for a Netflix subscription. And that strategy is working well so far. Moving on, the company's key financial metric or key business metric, global streaming paid memberships, continue to improve. The company ended the first quarter with 269.6 million global paid memberships. That was up by roughly 9 million from the previous quarter. What's more, if you look at the year-over-year growth in global streaming membership, it's accelerating. So not only are memberships increasing, but the rate of increase is increasing. Now, you've heard me talk about that second derivative growth here on my channel and how valuable it is to investors. Netflix is demonstrating that here. Year-over-year growth, 4.9% in Q1 2023, 8% in Q2, 10.8% in Q3, 12.8% in Q4, and 16% in Q1 2024. So an accelerating rate of membership growth for Netflix. Now, looking forward, the company is forecasting $9.5 billion in revenue for the second quarter and an operating margin of 26.6%. So, a bit of curious forecasting here for Netflix. First of all, if you look at the operating profit margin, 28.1% in the first quarter, 26.6% in the second quarter, right? So they're already roughly above 27% in terms of their operating profit margin for 2024. Yet, remember earlier, management forecast operating profit margin of 25% for 2024. So when you forecast 25% and you're already above 27, investors know how to do some math here and say, well, the second half of the year, the operating profit margin is going to be much lower than the first half of the year, roughly around 23%, so that it'll average out to 25% if that's what you're forecasting. Or could Netflix be lowballing on the operating profit margin forecast? That could also be true. So that's a bit curious there. One reason why the stock price was down, even after the company reported all of these great numbers, I shared with you at the beginning of the video, the stock price is down 5.15% in the aftermarket hours. So keep that in mind. That's one difference, one factor that's bringing down the stock price after hours. Another reason is, despite this excellent performance, the company's free cash flow barely improved to $2.137 billion in the first quarter of 2024, up from $2.117 billion in the first quarter of 2023. The reason why there was little growth here is an increase in content spending. The company spent a lot more on content in this quarter this year than the comparable period last year, which, while the market might view as a downside and kind of punish the stock here in the after hours, I see that as a good thing. Now, when I evaluate a company like Netflix that's demonstrated skill in their craft, which is creating content and getting people to subscribe and watch that content, that's their core capability. And if they're spending more money on their core capability, I'm happy about that. That's why I would want to invest in Netflix stock. That's why I would give Netflix money, is to do that, to take that money and make content, because that's what they're good at. That's what arguably they're best at, right? So investors getting upset about that seems a bit contradictory to me. Now, that's something that I look for when I'm investing in companies like Netflix. I want them to find content to make, right? Before they make content, they need to find content to make. They need to have ideas that they could turn into content. And what I would fear would be the opposite. If Netflix was not spending money on content, that's what would get me to hesitate for investing in Netflix, because I would say, oh man, they've kind of reached the limit of ideas. They can't find any new ideas to create and make and spend money on that's going to bring in a good return on investment. But when I see them finding areas to spend money on, I'm happy about that. That means that money that they spent on content is going to turn into shows and movies that people are going to want to watch. And that's going to lead to returning subscribers engaging more often. And now that they have ad-supported memberships, the more people stay engaged with Netflix, that's more ad revenue that could be generated. So I'm happy about the increased content spent, even though I can understand the other perspective where investors might say, well, they need to spend more now just to maintain the similar amount of engagement, which, while I understand some investors might make that argument, I think the data clearly supports Netflix in this content spending increase, right? They increased, if you look year over year, in the last year, they've added 37 million subscribers at higher revenue, right? They've increased prices, so the average revenue per subscriber is higher. Their operating profit margin is significantly higher. Their significantly higher profitability compared to all other streaming networks substantiates them and justifies their increasing spending in the category. So their ads membership I was talking about grew 65% quarter over quarter after rising 70% in the previous quarter. Now, incrementally, over 40% of all signups in their ads market are coming from ads plan. So customers, when they have the choice between an ad-supported version at a lower price subscription or the non-ad supported version at a higher price, almost half of them are choosing the ad-supported version, which signals that customers like this offering, that they favor this choice. They're choosing that more, frequently than I thought would be the case, right? I would prefer the non-ad version. I have the non-ad version. I don't like watching advertising. I subscribe to, whenever I have the choice to subscribe to a premium version for a few dollars more and avoid seeing advertisement, I choose that one, but I can understand individuals making the other choice. Okay, so now another one of the items from this earnings release that's bringing down the stock price. The company saying that they expect subscriber additions to be lower in the second quarter versus what they saw in the first quarter, and they attribute that to seasonality. So lower subscriber growth expected in the second quarter. That I don't have any arguments against. That is a reason for the stock price to decline. And then another reason why the stock price is falling is management saying that starting in the first quarter of 2025, they will stop reporting quarterly membership numbers and average revenue per membership. So I showed you how many members they added in the quarter, They're going to stop reporting that in the first quarter of 2025. So we can't see how many members they're adding or losing or the rate of growth, all of that. We're going to lose that data. And anytime a company goes from more transparency to less transparency, investors are going to throw a fit and the price is going to react. Investors like myself, we like to see more information about a company. It allows me to evaluate a company more effectively if I can see more data. If you're taking data away from me, that's making the investment more risky for me because I have less visual into what's happening inside the company. And so that's more risky. And if it's more risky, I'm going to be willing to pay a lower price than before. So this is what Netflix is doing, decreasing transparency, increasing risk. And so the stock price will fall as a result. And then you might say, why are they doing that? Well, the skeptical answer could be that they don't expect very much growth in subscribers. So if subscriber numbers are going to stop growing, they don't want to share that data anymore if it's not going to grow, if it's going to be flat or decreasing. If they share that information, that could be negative for the stock price. That's a skeptical view of why they might be doing it. Another view, the view that I find to be the most informative and the most likely, is it'll reduce volatility. As the company reports subscribers, one quarter might be higher, next quarter might be lower, it'll be up and down, and they don't want that fluctuating subscriber number to cause volatility in the stock price. So by removing that, they want there to be less volatility in the stock price based on subscriber additions and subtractions. That's the reason I think is most likely. Okay, so now to update my recommendation on Netflix stock, I told you I had the stock rated as a top 25 stock. I last updated that on March 31st. Today, April 18th, I'm reiterating that recommendation. I'm keeping it rated as a top 25 stock. And what I liked from the quarter offset the things I didn't like from the quarter. So far, I'm a little bit more bullish on Netflix stock than I was going into the quarter, and offset by the lower transparency from the subscriber, taking away from that subscriber data. So all of that being said, I still think Netflix is a top 25 stock to buy right now. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.